The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. Welcome to today's webinar titled Maximizing Paycheck Protection Program Loan Forgiveness. My name is Dan Fiorentino. I'm one of the partners here at Wilkin Gun Plan. I don't know what the weather's like by you guys, but right now in Jersey, it's very dark storms and a lot of rain clouds. So hopefully everything holds out for this webinar, but just kind of bear with us if we have any technical issues on that, but hopefully we'll pull through. As many of you on the line are probably aware, this is actually our third presentation that we've been doing related to the P3 loan process. This all started back in March 27th when the CARES Act was passed, and then in early April, a lot of businesses started getting their actual P3 loans. Looking at a calendar now, if you got your loan early April, you're at that point where you're getting pretty close to the end of your 8-week period. Now, there's a chance that 8-week period might change, which we'll get into later in the presentation, but if you're getting close to the end of your covered period, now's really the time that you got to start focusing on the loan forgiveness and how you're going to maximize that. So we figured now would be a great time to touch base with everyone and give you the latest information. If you've joined us on some of our other webinars, you're going to recognize some of the faces today for our speakers. You have me again moderating, and familiar faces are Len Nitty and Bill McDivitt, and we're also joined by a new face today, Carolus Matulis. And I apologize, Carolus, if I said your name wrong again. I'm getting better with that. So as I said on here, this information is constantly changing, so everything that we're going to go through on this is up to date through yesterday, June 2nd. Just going through some other housekeeping items on here, you're going to see over on the side, you have your GoToWebinar pane. You should be able to submit questions through there as we're going through the presentation. Hopefully we have a decent amount of time left at the end to answer some of those questions. And if not, we'll try to get back to you afterwards. If you'd like, you can also download a copy of the presentation. You should see that on the GoToWebinar meeting as well. If you don't download it now, you can check it out later on our website. We'll also be posting a copy of the webinar in addition to that. If you haven't taken a look at our website yet, I'd recommend you do check it out when you get some time. There's a lot of good resources on there related to COVID-19 and all the latest updates. And you can also sign up for our newsletter to make sure you're getting the latest information. Okay. Before I pass it along, I just want to go over a quick overview of the agenda. So first, we're going to talk about some loan forgiveness basics, and then we'll dive into the details on both payroll costs and non-payroll costs. Those are the two buckets that we need to focus on. You'll also see that payroll costs is going to include the owner compensation information. The last two items are probably the top thing on everyone's mind, the limitations on loan forgiveness, and then the biggest point on here is what can you do to maximize your loan forgiveness amount? So with that, I'm going to hand it over to Bill, and he'll give us a quick update on the legislation.
Okay. Hello, everyone. It feels like a lot longer ago, but roughly 2.5 months ago, the CARES Act was passed into law. And those of you that may have been following this legislation like we were know that the guidance on this dripped out slowly and periodically. So we are always constantly looking for potential changes. One significant potential change that is out there is the possibility of the Congress coming in and actually changing the law. The House passed a bill by a vote of 417 to 1, so it was pretty much unanimous, to extend the period during which the payroll can be paid, not just payroll, but all costs. And the House bill contained a provision that brought it out to 24 weeks from 8 weeks. Originally, the intention of Congress when they passed this law was that the 8-week period, they hoped at the time, would get businesses a financial bridge from the pandemic we're in the midst of to hopefully being on the other side of this healthcare crisis. As we all know now, as we sit here in early June, that's far from the case, and an 8-week period is woefully too short for many types of businesses. So there seems to be bipartisan and almost unanimous support to extend the 8-week period. So for the rest of this session, we're going to be talking about the way the law is now, and we're going to be talking about the 8-week period and other provisions as they stand now, but there's a potential that it changes if there's a legislative change. The Senate was talking this week about passing the House bill using what's called unanimous consent. That still may happen, but as of this morning and this afternoon, I'm reading that there's 2 holdout senators who aren't ready to jump onto this because they have some concerns which have not been specifically expressed. If the Senate can convince those two senators to join, then the House bill will be passed and the provision of the House bill would presumably become law and be signed by the president. Another provision that's in the House bill is the reduction of the payroll cost requirement from 75% to 60%, and an extension of the June 30th restoration date to December 31st, 2020. Last but not least, the House bill extended the repayment period for up to 5 years from a 2-year period. There's one other topic that has been the subject of discussion, which is the deductibility of costs paid with forgivable proceeds. This provision initially wasn't spoken to in the Act. The CARES Act specifically said that loan forgiveness, which is normally subject to income tax as income, would not be taxable specifically. And then later the IRS came in and said, based on that fact that the loan forgiveness wasn't taxable, that the expenses related to loan forgiveness were non-deductible. So it kind of put taxpayers in the same position almost exactly as if the forgiveness was in fact taxable. And many voices rose in Congress to say that wasn't their intention. And it is possible that Congress comes back and it's going to take a legislative change, I think, and identify that the expenses paid that have been forgiven are deductible. Just to know, it's not, that provision is not in the House bill right now, nor is it in the Senate bill. Who knows what will happen in the next few days. But that law, if it's passed and changed, could happen as late as the end of this year. On to Lenny.
Thank you, Bill, and thank you everyone for joining us today. So I think the PPP loans have been a little bit of a wild ride and are continuing to move and change as we speak, as Bill just addressed some potential legislative changes that could be coming that may significantly alter quite a bit of what we're going to talk about today. But, you know, it started out with a good, simple concept, and, you know, every few days the rules seem to change. Sometimes better for business owners, sometimes worse, depending upon the topic. But, you know, as we stand today, we're going to give you all the information we have, and just be alert as you move forward in this process that there could be some quirks that come up or some additional guidance that come up that may change how certain things will be treated. And also, we do still need some guidance in terms of forgiveness, and we'll point out a few of those areas as we go through the program. So to get started talking about loan forgiveness, just want to talk about some of the basics. So loans, PPP loans can be forgiven if you use the proceeds on qualifying costs paid or incurred during the covered period, or with the latest guidance, they've introduced an alternative payroll covered period, which we'll speak about. So if you've properly spent the proceeds on qualifying costs, those can qualify for forgiveness. As Bill said, there was a 75% requirement that the proceeds be used on payroll costs, and not surprisingly, there's also a requirement that not more than 25% of the forgiveness amount can be used on non-payroll costs. So effectively what that means is, you know, you could have a proration of some of your non-payroll costs being forgiven and others not. Say you had a $150,000 loan that you received and you were able to use 100 of it on payroll costs and 50 of it on other qualifying expenses. The forgiveness on the non-payroll costs would be capped at $33,000 and change, because at most 25% of the forgiven amount can relate to non-payroll costs. So just keep that in mind. It's going to be very important and critical to try to meet that 75% component on payroll costs as we go through this, so that you can maximize forgiveness. In order to be granted forgiveness, you must apply for forgiveness with the lender. And about 2 weeks ago, the SBA gave us an application for forgiveness, which kind of gave us a little peek into what some of the final interim rule is going to say on forgiveness. And that application is now live with many lenders, and I know the lenders have been sending these out to the borrowers. Once the application is filed, the lender has 60 days to issue a decision on how much will be forgiven. Once that decision is issued by the lender, the SBA has 90 days to react and remit forgiveness amounts to the lender, effectively canceling that portion of the loan. So keep that in mind. It is going to be a longer drawn-out process where between completing the application and then giving the lender 60 days and the SBA another 90 days, you're probably looking at least a 6-month process before you're granted forgiveness.
Hey, Len, quick question on that. Is there a timetable of when the borrower has to submit the application for forgiveness?
It's a good question, Dan. The application instructions itself does not set a due date for when a particular borrower would need to file the application. Instead, what it does is the application has an expiration date, which is October 31st, 2020. So in theory, perhaps that's the due date for all loans, or it's also possible they could revise that and give a shorter window for some of the earlier loans to apply for forgiveness. And that may entirely change if we end up being extended to a 16 or 24 week period as well.
Thanks.
So for loan forgiveness, if the loan or a portion of the loan is not forgiven, then what happens? The interest rate is going to be a 1% fixed rate on the loan. The loan would be due in 2 years as we currently stand. Payments would be deferred for the first 6 months, including interest deferrals, but interest would still accrue. And should a borrower or a business choose to pay this off early, there is no penalties or fees associated with doing that. So in theory, a borrower, if they didn't want to pay that 1% interest rate, as soon as they get a ruling on their forgiveness, could go ahead and pay the balance back to minimize any future interest. Although any interest between the date you receive it and you pay it back is subject to the 1% rate, but only on the amounts not forgiven. If the loan is forgiven, the interest is also forgiven on that loan. So what is the covered period? The covered period begins on the date that you actually receive the PPP loan proceeds. And that starts an 8-week period where the proceeds need to be spent on qualifying costs. This is the rules that were in the CARES Act and also in the earlier guidance and interim rules provided by the SBA. When they issued the loan application and also the interim final guidance on forgiveness, they tweaked the rules a bit, and this is where it gets a touch more complicated. They created this alternative payroll covered period, and it's still an 8-week period, just like the covered period would be, but it only applies to businesses with weekly or biweekly payrolls. And what the government wanted to do is make it easier for those smaller businesses who are paying employees weekly or biweekly and allow them to sync their covered period for payroll costs up with their normal payroll cycle. So they wouldn't have to go through and calculate, well, how much of the payroll, how much of each payroll would qualify for these forgiveness and whatnot. So designed to make things easier for those taxpayers. And it's elective at the borrower. It's an election made by the borrower. So you don't have to use the alternative payroll covered period if you do have a weekly or biweekly payroll. But where it makes it a little more complicated is if you elect this alternative payroll covered period, you're now dealing with 2 different covered periods, because the alternative only qualifies for payroll costs where all of your non-payroll costs that qualify for forgiveness must be spent in the initial covered period, which begins with the date that the loan is received versus the first day of the payroll cycle following receipt of the proceeds. So, and these rules are a bit complicated, so I will do my best, and I'm sure Carlos will do his best to keep things simple, but just know that these things do get complicated, so if you're not fully following something, you're not alone. Don't be surprised. So what costs qualify for forgiveness? Payroll costs, and as we said, must be at least 75% in order to qualify for forgiveness, and Bill's going to go into more detail on payroll costs. Additionally, any payment of interest on any covered mortgage obligation qualifies. Any payments on covered rent obligations and a covered utility payment for which service began before February 15th, 2020. And I'm breezing through this slide because we're going to go into more detail on all these. And with that, I'm going to turn it back over to Bill to talk us through payroll costs.
Thanks, Len. So all these concepts sounded simple in the very beginning. It's like many things in legislation. The concepts can be articulated in a quick sentence, but the reality is there's a lot of complications in covering this. So the forgivable payroll costs are the payments that are made during the covered period or incurred during the covered period. The law originally said paid and incurred, and the guidance that we've gotten says paid basically or incurred during the covered period or alternative covered period. So that is helpful to employers. Payments to furlough employees also qualify, and bonuses and hazard pay would also qualify. We'll come back and talk more about bonuses in a second.
Yeah, Bill, just one follow-up question, just to make sure that it's clear for everyone, is if it's incurred during the covered period but not paid during the covered period, is there a timeline where the payroll must be paid in order to qualify for forgiveness?
It's a good question. The portion that's incurred during the covered period will qualify as a forgivable payroll cost as long as it's paid at the next normal pay date or pay cycle for that business. So as long as you adhere to, let's just say you have a bi-monthly payroll and your covered period ends 5 days into that period, 10 days later you pay the payroll, that 5 days that was incurred during the period would count, even though it was paid after the period closed. Good question, Len. So this slide should look familiar to anyone who's made the application. There's really nothing that's changed here. Payroll costs include more than simply straight payroll. It's salaries, wages, and the first 4 bullets are all elements of what we would all think about as salary and wages. It also includes the employer portion of group healthcare benefits and the employer portion of retirement benefits, and last but not least, the employer portion of only state and local taxes on payroll. So those concepts have not changed at all. Here's where there has been a little bit of a change. So the compensation for an individual employee cannot exceed an annual rate of $100,000, which is, if you take 8/52 of 100,000, it's $15,385, and that is the cap for an employee during a covered period. This cap is not necessarily new, but it's been tightly defined at this point, and it leaves open the question, which we're going to talk about in a little bit more detail. The way the law is written now, if you had an employee that had only received, say, $10,000 during the covered period, and you paid them a $5,000 bonus during the covered period, the way that the law is written now, you can count that employee for $15,000. And it's possible that there'll be a clarification that'll come in the future from the SBA and say that you can only take, assuming that was an annual bonus, that $5,000, that you can only take 8/52 of it. But the way that the guidance is written today, you would take the bonus that's paid during the covered period and it would qualify. The other economic risk you have is if you pay an employee an annual bonus early and then they subsequently are not an employee, then you've lost some funds because there wouldn't be any way to recap that. I think that's it on this slide. In this area, there was some clarification that was, I'm going to say, more or less expected and helpful. And there were some other new concepts that weren't in the law or anywhere else until we got the application and the most recent interim final rule. So owner-employee compensation is capped at 850 seconds, which is 8 weeks of a 52-week year, of the 2019 income amount. And it's also capped at $15,385, which would be inclusive of retirement and medical benefits. When we made the loan applications for an owner-employee, we would have capped the owner-employee's comp at an annual rate of $100,000 in calculating the average monthly compensation that we took 2.5 times of. And then we would have, in addition, taken the retirement benefits paid for that individual who's an owner-employee and medical benefits, because at the time that was what the guidance said. Now, when we get to forgiveness, this concept has emerged that for owner-employees, you cannot count dollars in excess of $15,385, inclusive of retirement and medical benefits. So to give a little example, if someone was making $150,000, their salary would be capped at $15,385, and we wouldn't consider retirement and medical benefits. If someone was making, say, $12,000 during the 8-week period, you would be able to have room for $3,385 of retirement and medical benefits for that owner-employee. For sole proprietors, it was really kind of a mystery. How does a sole proprietor pay itself to determine what owner compensation is? And we've received guidance that clarifies this. It's simply 850 seconds of the 2019 net profit, again, capped at the $15,385. General partners, this was also a late kind of breaking concept. There was some inequity perceived in the law the way it was written, and then the guidance beyond the law allowed for general partners to be considered. And basically what you consider is their self-employment income up to 850 seconds of the 2019 self-employment income multiplied by 0.9235. So the 0.9235 isn't literally explained. We have some theories about what it may be, but again, it's capped for a general partner at $15,385. For sole proprietors, I'm sorry?
Did we want to get into what we think those estimates are for that 0.9235 or at a later date?
That's fine. The thought process might be there for a general partner. They get paid a gross compensation, and there are no payroll taxes. And there's some thinking that this 0.9235 is to exclude what might otherwise be the employer portion of payroll, federal payroll taxes. But that's just a hypothesis. It's not explained. It's in the vicinity of being the right number. So that's what we're thinking it may be. Thanks, Dan. So again, sole proprietors, self-employed individuals, and general partners do not get to count medical or retirement benefits at all. So that has been clarified. It's not business friendly, but it's been clarified. And then the cap is based on compensation from all entities owned. So now we get into some observations and open questions. So the point we talked about before with shareholder employees is that there is this limit, which is $15,385, and then you wouldn't be able to add on top of that amount the retirement and health benefits. That is nowhere in the law. It's kind of a new concept that has just come out in the guidance. It's quite possible that gets fixed on further guidance that comes down the road. Right now, it appears that contributions to retirement plans need to be paid during the 8-week period in order to qualify. So we'd have to talk about the appropriate timing of that. And it appears that more than 8 weeks of payroll can be included if prior payroll is paid during the covered period. So when Lenny asked me the question earlier, he was talking about a question of at the end of the 8-week period. It's also true at the beginning of the 8-week period. If I'm into 10 days into a pay cycle that's 2 weeks long, and then 4 days later after I've received the money, I pay that 2-week payroll, that entire 2-week payroll will be counted in the qualified period. So there could be a possibility that there's a piece of payroll incurred during the beginning of the 8-week period or before the 8-week period begins and after the 8-week period. So you could end up with more than 8 weeks of payroll in the calculation. And then last but not least, and this is probably not the last mystery, but there could be others, the SBA may come along and say, if you do in fact advance your retirement contribution or bonuses, they may ask you to prorate it. Based on the way the law is written now, if you pay it during the period, they'll be counted. So more guidance to come. Glenn? Glenn, you're muted. I think he's muted.
Yep. Thanks, Bill. So transitioning over to forgivable non-payroll costs. In order to be forgiven, the cost must either be paid during the covered period or incurred during the covered period and paid by the next regular billing date. Similar to concept to the way it is for payroll costs. What doesn't appear to be included here, doesn't seem to be a way to capture it, is say that you paid your May rent when it was due on May 1st and you didn't get the loan proceeds until May 3rd. So clearly you're incurring those expenses during the covered period, but you've paid them before. It appears that those would not qualify for forgiveness. And in theory, I guess it makes sense because you couldn't have used your loan proceeds to pay that expense because it was paid before you actually got the proceeds. So just keep that in mind. They've also specifically laid out that advance payments of interest on mortgage loans do not qualify for forgiveness. So in theory, there's nothing that would prevent you from prepaying some other qualifying non-payroll costs if you needed additional costs to reach your full forgiveness potential. And we'll talk a little bit more about that as we get into some of the observations and open questions with regards to non-payroll costs as well, but keep that in mind. Right now, there doesn't appear to be anything preventing you from making advance payments with the exception of mortgage interest, which is clearly defined in the interim final rule as not qualifying. So for non-payroll costs, mortgage interest, what's included in these costs? It's going to be interest on mortgages on real properties. Also is going to be interest on debt for personal property, such as auto loans, office equipment, anything else that you may have taken out debt on to acquire personal property. Principal payments do not qualify, nor do prepayments qualify for forgiveness. The mortgage must have been incurred prior to February 15th, 2020 in order for it to qualify for forgiveness. So one thing they didn't want to allow to have happen is for these proceeds to be used for capital acquisitions. They really wanted this to be more focused on maintaining payroll costs and other expenses that were currently on the business's plate. So if you've taken out a mortgage or a loan to acquire either real or personal property after February 15th, 2020, you're not going to be able to qualify for forgiveness on that interest.
Hey, Len, do you want to just spend 1 second? I think interest is one section that tricks people up a little bit because there were different rules, I think, between what was allowed in terms of interest and what could be forgiven. Is that right?
Yeah, so, when they gave us the interim final rule, they essentially gave us a number of categories that you can use the proceeds on, and then a tighter set of categories or a smaller number of categories that you could actually qualify for forgiveness on. So in terms of qualifying uses of the proceeds, they included interest on any type of debt of the business. So the business could have a line of credit and be paying interest on that line of credit. That was a qualifying use of the proceeds, but unfortunately, it does not qualify for forgiveness. Only mortgage interest, which includes interest payments on debt related to purchases of tangible personal property qualify, but unsecured loan interest does not appear to qualify.
Got it.
So what about lease payments? Payments on leases for either real property or personal property qualify as well. So whether it's a copier you're leasing or a postage meter or anything along those lines, or car for that matter, these are all qualifying non-payroll costs that could qualify for forgiveness. And again, they didn't want to encourage capital purchases as part of this. So the lease agreement must have been enforced prior to February 15th, 2020. Then brings us to the final non-payroll cost that qualifies for forgiveness, which is utilities. And they outlined a few, or listed a few, I should say. They didn't really give much detail for these. But electricity, gas, water, transportation services, telephone services, and internet services all qualify as long as the service began before February 15th, 2020. The one I want to kind of just highlight here is transportation services. They didn't really give us a sense or a definition of what transportation services means. Is it intended to mean shipping services, whether it's a FedEx or UPS, or a car service that a business may be using? What I don't think it would include would be auto repairs or gas purchases for cars, simply because it needs to be a service that was in place before February 15th, 2020. So I could see having a service with a shipping company qualify, or a car service, or whatever it may be. But just keep that in mind. Hopefully they give us some more clarity on that one in particular, because it's hard for me to tell you exactly what that one means without additional guidance. But something that's more along the lines of a service to me, rather than a spur of the moment repair or oil change or some level of gas put into the vehicles owned or leased by the company.
I got a question on here, Len. Do you think telephone would also include cell phones?
I would expect it to. They didn't go into depth on any of these, but certainly I would expect a cell phone to be considered a telephone service. The other thing they didn't really do, or didn't do at all, is address, some of these could be part business, part personal use, especially for someone like a sole proprietor who may be doing business out of their house. So it's unclear how to approach non-payroll costs for utilities in that regard if you have a mixed use where some of the same cost relates to personal and some of it relates to business use. So we'll have to keep an eye out to see if they give any better clarity on that one as well. So observations and some open questions on non-payroll costs before we get into the more complicated topics. But as we said earlier, advance payments appear to be allowed other than the mortgage interest. So could be an opportunity for planning to accelerate some payments if you're able to maximize forgiveness there. As I identified, transportation costs have not been identified, nor have mixed use types of utility services. And I guess in terms of payments in advance, it's easier to visualize paying a mortgage in advance because you have a lease agreement, not a mortgage, but I'm sorry, a rental payment in advance, because you have a lease agreement in place outlining what you need to pay when you need to pay it. But what about utility payments? Are they going to allow you to prepay utilities if you don't have an invoice? How do you even go about prepaying the utilities if you don't have an invoice? That one might be more challenging than it is to prepay some lease payments. And will they institute a cap on advance payments? I don't know, but if they see everybody lining up to pay, rents a year in advance to try to take advantage of this, they may look sideways at it and want to create some level of common sense, or non-common sense for that matter, method of capping advance payments. I don't know if they'll do that or not. Right now, there is no cap instituted on advance payments. So as I said, now we're going to dive into some of the more complicated topics. So these will be a little trickier to follow along with. But we talked about the initial limitation on forgiveness, where at most 25% of non-payroll costs could be forgiven. So that right there is potentially a reduction or a limitation on your forgiveness amount if you weren't able to use 75% of the original loan proceeds on qualifying payroll costs. There are these two other limitations that we're going to go through now, and the first one deals with full-time equivalent employees. And what the government didn't want you to be able to do is to cut your workforce significantly and still qualify for forgiveness on your PPP loan. They wanted you to keep people employed and continue to pay people at the rates which they were being paid. So the first one deals with measuring full-time equivalents. And you have two choices in terms of how you go through and calculate forgiveness. The first one is you look at your average full-time employees per month during the 8-week covered period or the alternative payroll covered period, compared to your average full-time employees per month during the period beginning on February 15th, 2019 and ending on June 30th, 2019. So say that you had 8 full-time employees during the covered period, but during this first period, the February 15, 19 to June 30, 19, you had 10 full-time equivalent employees on average during that period. You'd only be entitled to an 80% forgiveness on your otherwise forgivable costs because you didn't keep enough full-time employees in place during the period. And we'll talk about some exceptions to this rule in a minute, but I did just want to get this out there first. The other option you have is still measuring your average full-time employees over the 8-week covered period or alternative covered period, but you're comparing it to average full-time employees per month during the period beginning on January 1st, 2020 and ending on February 29th, 2020. So in terms of deciding which one to use, you're going to want to look at whichever gives you the better result naturally. And the one that's going to give you the better result is in the historic periods, whichever one gives you the lowest number of full-time equivalent employees. I do want to note, but I don't want to spend time here because we're a little tight on time, that there is an adjustment for seasonal employers in terms of doing these calculations. And if you are a seasonal employer, feel free to reach out to me after the presentation. I'm happy to talk through or respond to an email question to give you a little more guidance in this area. So full-time equivalent employees, it's based on a 40-hour work week. So if you have a full-time employee, they're going to count as one regardless of the number of hours. I've had some clients ask and say, well, if some of my employees are willing to work 60 hours, can I count them as an employee and a half since we're falling short on full-time equivalents? Unfortunately, the answer to that question is no. Regardless of how many hours a full-time employee works, they're capped at a 40-hour week and only getting credit as one employee. So then you'll go to your part-time employees and you have two options for calculating these, and Carol is going to get into more detail on these as well, so I just want to touch upon these. You're going to calculate it based on a decimal for each part-time employee. So if you had an employee that worked 30 hours out of a 40-hour week, they would count at 0.75 employees. There's also a simplified approach where you could just use 0.5 for each part-time employee, make it easier, especially if you have a lot of different part-time employees rather than perhaps going through and calculating the decimal for everyone. So keep that in mind. There are some options for how you calculate part-time employees. Then I said we would talk about some exceptions to the full-time equivalent limitation as well. The big exception is that if you restore your full-time equivalent employee count by June 30th, 2020, and keep in mind this date may change with the current legislation floating around, is if you restore it by June 30, 2020, you can disregard this limitation. So even if you're having a difficult time getting employees back or restoring them to full-time hours, as long as you can get them restored by June 30th, 2020, you don't have to deal with this further limitation. You may be short on payroll costs if you have a hard time getting your employee count back up before June 30th. But you won't be subject to this additional limitation. So there's also an exception for employees who either voluntarily leave or request reduced hours during the covered period, or alternative covered period for that matter. So this only is during the 8-week covered period though. So unfortunately, if you had somebody leave between March 15th and the start of your covered period, even if they've left for voluntary reasons, you don't get an exception to this full-time equivalent limitation. So it's not the fairest thing necessarily, but that's the way that the guidance currently reads. Additionally, I was a little surprised by this one, but they are allowing you an exception for employees fired for cause during the covered period. So if you had to let somebody go for cause or poor performance, you don't have to count them against your full-time equivalent limitation. And this is the big one that I think a lot of businesses are facing right now, and that is the reduction in full-time equivalent employees is because you have employers refusing to return from unemployment because unemployment benefits are just so great right now with the federal add-on to the state incentives. You know, a lot of employees could potentially be making more on unemployment than they would be if they were being paid by your business. So if the reduction is due to this, they're going to allow you to exclude them from this limitation calculation. However, there are a few strings attached, and you do have to do a number of things to be able to exclude them from this calculation. So what do you need to do? You have to have a written offer to rehire the employee, and the offer has to be for the same pay or hours prior to their going on furlough. The offer has to have been rejected by the employee, and you need to maintain records to document all of this has been happening, dates. You'll want to have proof, whether it's emails, certified letters, but you need to go through these steps. And the fifth one is going to be the tricky one for a lot of business owners, because when they first teased out this exception to the rule, what they had said was, you know, the business owner was going to have to notify the employee that this may impact their unemployment benefits, or I'm sorry, rejecting the offer may impact their unemployment benefits. And I think that was an easy enough thing for a business owner to do, is put it in a letter to the employee that it may impact. But they've taken it a step further in the interim final rule for forgiveness, in that the borrower actually has to inform the applicable state unemployment insurance office within 30 days of the rejection. So you actually have to report your employee who refuses to come back to unemployment to the state, and therefore, you know, subject then to potential penalties perhaps, but certainly a cutoff of their unemployment benefits to get them back to work. I think some businesses may be uncomfortable, especially for better employees, of going through this step. So this is available, and I guess each individual business will have to get comfortable with this on a one-on-one basis. And I said there was a second limitation as well for a reduction in salary. And this, in addition to keeping the same number of employees, they don't want you to cut anybody's pay significantly and still qualify for forgiveness. And this is really in place to protect those employees who are earning less than $100,000 a year. So if you're earning more than $100,000, if you have an employee earning more than $100,000 per year, this rule isn't meant to protect them. You could cut their salaries and not have to necessarily worry about it. But what the rule is, if you've cut any employee who was earning less than $100,000 per year last year, and you cut them in excess of 25% in total salary or wages of the employee for the most recent when you compare it to the most recent full quarter during which the employee was employed before the covered period, you're going to have to take a percentage reduction as well for that. So there'll be a further limitation of your forgiveness amount if you cut employee salaries too much. Now, there are a couple of exceptions to the reduction of salary limitation. Again, you're able to restore them to a full salary or 75% of their original salary by June 30th, 2020. That's the easiest way to make this go away. The other thing, which is just common sense, which they put out there, is that if the reduction is strictly due to reduction in the full-time equivalent employees, they're not going to penalize you twice. So say that you had an employee, you know, working 30 hours a month or 30 hours a week, and they were earning $10,000 for that. That's a bad example. They were earning $1,000 for that, those 30 hours. If you cut them down to 15 hours, and in turn their comp went from, you know, $1,000 down to $500, that reduction is directly attributed to the reduction in hours for full-time equivalent employee purposes. So there you're not going to have an impact. You don't have to count those employees again to further create a limitation and effectively create a double penalty for those employees. But where it would impact you is if not only you took that employee down from 30 hours to 15 hours, but you also cut their rate of pay, say from $30 an hour down to $25 an hour. Or not 25, 25 is a bad example, but 30 to 20 hours, because there you've had a 33% reduction in their pay rate, which is more than 25%. So keep that in mind as you go through these calculations. And as you can see, this is where things get very complicated in terms of the limitations and these types of calculations that you have to go through. And in order to request forgiveness, you have to submit a request in the form of an application to the lender. You're going to have to include a number of documents to verify the number of full-time equivalent employees and pay rates before and after, your payments on eligible mortgages, leases, and utility obligations. You're going to have to certify that the documents are true. The lender must make a decision, as we said, on forgiveness within 60 days, and then the SBA has another 90 days to act on it. As we said, I think we said this earlier, but for federal tax purposes, the amount of debt forgiveness shall be excluded from gross income. However, as we currently stand, any proceeds which are forgiven and used to pay a qualifying expense, you don't get to deduct that expense. So even though they've allowed you to exclude it from gross income as we currently stand, effectively you're paying tax on those proceeds because you don't get to deduct the associated expense. So we'll see if they fix that. And with that, I'm going to turn it over to Carolus to go through the more complicated stuff and hopefully make some of this a little bit simpler, and also share a tool that we've developed to help maximize loan forgiveness amounts.
Yeah. Hey guys. So thanks, Len, for that great introduction. And I think we've covered a lot of theory thus far, and I just want to segue into a more practical discussion of how you actually compute a lot of these components that are so crucial in the forgiveness calculation. And in my view, there's really two things that are happening here, and what the application is seeking to quantify is the component of time and the component of compensation. So the component of time seeks to look at the time that the employees have worked in the past, how many hours did they used to work, and compare that to the time that they're working now during the covered period. And same thing with compensation. Compensation seeks to take a look at the rate of pay that they've been used to getting in the past, and to make sure that what they're being paid now isn't substantially lower than what it used to be. So these four components here, I'm going to briefly talk about them. I know Len has already beat up some of these topics already, but I want to just cover them in terms of grounding the theory with some practical application and how these things are going to be computed. So the four items are going to be the covered period versus the alternative payroll covered period, the full-time equivalency calculations, and the standard methodology versus the simplified method, the FTE reduction safe harbor, and the wage salary reduction and safe harbor. And again, if we think about it in the context of time and compensation, the first three are really dealing with the time component, whereas the last bullet point here deals with the compensation component. So what is the best way to maximize forgiveness? Well, the best way to maximize forgiveness is to calculate it. So what I will advise is that, a system, some sort of organized system is highly recommended in terms of getting your arms around the forgiveness calculations, because there's a lot of moving parts in play, and they kind of have an impact on each other. So we're going to go into the covered period discussion. The covered period, as Len mentioned, starts on the date the loan is dispersed, but at the borrower's option with an election, the borrower may be able to choose a alternative covered period. This is only available to borrowers with a biweekly or more frequent payroll schedule, and it's really beneficial for those where the date that the loan funds came in doesn't really align well with their payroll schedule. Now, the reason why this is important, and I'm going to use this track analogy for some of my presentation, so all the track stars can hopefully understand where we're going with this. The covered period is really the starting line for all of the calculations that are to follow. A lot of the time-based calculations use the covered period as kind of the flagpole from which all of the time logic originates. So it's important to have a good starting point in order to maximize the amount of expenses that you're able to include into the covered period. So you should be able to run the analysis both ways, with the alternative covered period and the original covered period to see what works best for you in terms of computing forgiveness.
Hey, Carolus, just to kind of reiterate what you're saying on there then, so the best way to maximize loan forgiveness to calculate it, you're saying try these two different scenarios, calculate them, and how soon do you think people should do that? Should they do it after the 8-week period or ahead of time?
So ideally you want to be, proactive with all your calculations. And
Gotcha.
if we have an extension to the 8-week rule, we might have a bit more time. I know for some borrowers, we're already approaching the 8-week mark, and it may be beneficial to take a look and run both scenarios both ways and see what works best for your circumstance. So the next topic that I want to cover is the full-time equivalency calculations. And again, I'm going to be using the starting point analogy. So depending on which starting point we have chosen, the full-time equivalency calculations become pretty important, because what we need to do is we need to measure each employee's track performance. So each employee has been running, continuous foot races in the past, and we need to be able to take their historical performances, and we need to be able to compare their performances from, last year or whatever reference period the regulations call for, and we need to compare that to their performance during the covered period. So again, it's highly dependent on whatever your covered period start date was, but then here you have another branch in terms of how you can go about computing the amount of time the employees spent working. So the one option, as Len has mentioned before, is the standard methodology, where the average number of hours worked per week is divided by 40 and rounded to the nearest tenth, which is capped at 1. And this is done on a employee basis. So you're gonna have to run this calculation for each employee, and this calculation will have to be run for different periods of time for which the regulations call for, and there, as you'll see in a minute, there's actually quite a few time periods for which the data is needed. And to that same point, if you choose the simplified methodology, you'll have to perform all those calculations as well. So the FTE reduction safe harbor, I'm not going to cover this too much. The one thing that I want to point out here is the fact that, again, there's a lot of periods and a lot of dates, and all this is different segments of time for which you have to measure your employees' compensation and time metrics. So this is from a tool that we've kind of been developing internally to help compute forgiveness, and what it really does is it exemplifies the amount of computation that you're going to have to put in to come up with your forgiveness amounts. There's full-time equivalents for different cover periods, for different reference periods, and the periods are also different for some of the safe harbor tests. So it's pretty crucial to have some sort of system in place that allows you to quickly slice and dice your full-time equivalent calculations based on different dates. So if we were to change the date of disbursement, or if we were to use the alternative cover period, all of the full-time equivalent calculations will have to change accordingly because we're looking at a different period of time.
Hey, Carlos, quick question on that, and I don't want to interrupt you too much because I know we're running a little short on time, and sorry for anyone. We're probably going to go over a couple minutes over that, but we'll do our best to stay in line. So this Excel file that you're showing here, is this something that we're releasing, or is this more something that we're keeping internally?
So we're going to be keeping this internally, and really the reason for that is it's a bit complex and convoluted, and it's pretty difficult for us to ensure that whatever the end user is going to be producing with this Excel is actually the right calculations without kind of keeping close tabs on all the inputs and all the outputs. So for the time being, we're going to be keeping this internal. But if anybody needs help with their calculations, feel free to reach out to us. We'll gladly help. So the one last thing that I want to mention on the screen is the FTE reductions, the exemptions, and Len touched on this before. So to the extent that you're able to fulfill the safe harbor exemptions or exceptions, you should be able to reduce the full-time equivalents by those incurred by that specific employee that has some sort of exception rule met. So because we're running a bit low on time, I'm not going to cover this too much. This is actually straight from the SBA application, and for those that have seen it, this should look pretty familiar. What I want to illustrate here is the compensation segment of the calculation. So we've kind of covered time with the previous slide and the previous calculations with the FTEs. What the borrower will have to do is we'll also have to compute compensation, and I would probably liken this to the speed at which the track stars are running around the track. The SBA does not want the runners to slow down by more than 25%. So there's a whole lot of convoluted logic in the application, and I'll show you this in kind of a table format to kind of illustrate the point. There's some decision trees here that need to be covered. So the step 1, step 2, and step 3 are all part of the SBA application. So what we've done is we've kind of taken all of their instructions and built this decision tree in our Excel where we're able to go through and compute any of the reductions that employees incurred, or to the extent that an employee is covered by some sort of safe harbor, then this reflects that as well. And this is kind of what it looks like. So we've covered the time component. This is really the compensation component. We have the compensations for the covered period, and we have the compensations for our reference period. So again, we're comparing what the employee was paid during the reference period versus what the employee is being paid now that the loan's been received. And to the extent that any exceptions apply, or if the reduction in their pay is not above 25%, you don't incur a problem. But so this is kind of a summary of that. And putting it all together, so the SBA application calls for the completion of these worksheets, where the borrower will have to enter the cash compensation per employee, the average FTEs per employee, and there's actually 2 different tables. There's table 1 and table 2, depending on the compensation levels. If somebody's over $100,000 or below $100,000, they'll have to fill out these separate tables to then populate Schedule A with table 1 and table 2 amounts in the application. So the other consideration that's probably worth mentioning is the documentation requirement. Borrowers are going to have to document their non-payroll expenses pretty closely, and they're also going to have to document their payroll expenses accordingly. So hopefully, I kind of flew through this pretty quickly in the interest of time, but hopefully hopefully it gives you a little bit more color on the process of actually computing the forgiveness as required by the SBA application. So Dan, I don't know if you have any closing comments.
Yeah, I'll wrap it up. Thank you. Nice job. So just to kind of reiterate what we're going over there with the tail part of Len's presentation and Carol's is, as you can see, this isn't exactly an easy calculation. You know, there's a lot of work that has to be done through this, and it makes it a little bit more difficult because some of the rules could be changing. The best thing you can do right now to kind of maximize your loan forgiveness, you know, run through some of these calculations before your 8-week period ends and see what you think is going to get the best results. You know, can you consider advancing some expenses between payroll and even non-payroll? There's different options out there. Stay connected to us with the most recent information. That way, if the rules do change, you'll be well aware of that. And thanks for joining our webinar, and we'll look forward to talking to you more in the future. All right, talk to you later, guys.